Not all housing data is created equal. We've got a new report out from Redfin, their rental market tracker. But let's take a little bit of a closer look, because you might not want to take everything in that report as fact, like many national media outlets are doing when they're reporting on real estate, which is going to give a lot of people really just a bad idea of exactly what's going on in the housing industry. If you're a real estate investor, active, passive, just curious, or you've been in the industry for decades, this is the YouTube show podcast. It's really been designed for you to keep you up to date and up to speed. All the new research is coming out, the data, news articles, and then wrapping it up with some original opinions from Dr. Matt Bosnagel and myself. We're here at the Great Capital Studios at the Great Capital headquarters in Indianapolis, Indiana. A lot of other good reports. Let's get into it. All right, everyone. Welcome back to the Great Capital Studios, Great Capital HQ. We're in Indianapolis, Indiana. Joined by the one and only Dr. Matt Bosnagel.
It's good to be back.
How's it going, Matt?
Pretty good.
Awesome. So far, getting through the week.
Oh yeah, a lot of good work. A lot of good work to be done this week.
A lot of work to do. Matt.
Yeah.
Interesting reports coming out. We were just talking before the show about this new report that Redfin just brought out. The rental market tracker, U.S. rents post first annual decline in 3 years.
Yeah.
Now, that's not exactly shocking, because we know that there's been some slow growth and even declines nationally over the last kind of quarter or so, kind of starting halfway through 2022. So it's not a shock that we maybe see some declines.
Yeah.
But when you look at a couple different sources, some things start to, I guess, pop out in the Redfin report that I guess are a little bit questionable. And you were coming a little hot.
Yeah.
Being like, man.
Well, it's not Redfin's fault.
It's not Redfin's fault, but their store's getting picked up.
Yep.
And you're tracking, so we track like a handful of different sources on rent growth, a couple other KPIs, but really looking at rent growth just to see, who's right, who's wrong, comparing their methodology. And it seems like Redfin's all over the place. And so for all these national media outlets to kind of pick up this story, as a headline, you're just like, oh man, people aren't just getting the real picture. What are your thoughts?
And it's funny, even in that article, even in the report itself from Redfin, it was like people were characterizing it as more of a normalization than an outright decrease.
Yeah.
If rents really were declining by 0.4 on the national level, would be in a lot worse situation. There'd be a lot more people pulling their hair out. And I don't think
but rents have been down though, right? I mean, Austin, Phoenix, all of those markets.
But the fact that if we were to see this negative trend continue, because we're getting into peak renting season, we should see a bump up at this point, which we are in other rent.
So what's the period on this? Let's pull up the Redfin report. What is the period? Because I mean that's a good point. I mean, are we talking about Q4 of 2022? Are we talking about Q1, or are we talking about just for March? Now, March we've seen has been a very positive month.
Yeah.
So that is, but the headline is for year over year.
The beginning, it's a year over year number, but and that's a good point too. Is that the year over year, those numbers for rent growth are going to be ever smaller because we're going to be packed up against last year's stellar numbers for the beginning of the year. Now, it shouldn't go negative. That's not this division relationship, the comparative relationship. But the fact that this is going negative just it raised my eyebrows a little bit. And then really...
So, I mean, they're saying that last year, March of 22, rent was $1,944 on average, or the median U.S. asking rent. But today, in March of 2023, median rent is $1,937. So relatively marginal. You could really just call it flat.
Yeah.
But I mean, are they wrong?
Well, they're using the data that they've given, and their data is at odds, I think, with other reporting. And really, I think that the people that I'm most disappointed with are some of the media outlets that have, I think, mischaracterized the apartment market. And really, it's a comment on the coverage. So we get headlines like apartment rent prices fall as new units hit market from CBS. And then there is apartment rents fall as crush of new supply hits the market. That's from the Wall Street Journal. And rents fall annually for the first time in 3 years from The Hill. You could read that and you're thinking, oh man, rents are falling. I mean, are you going to argue with the Wall Street Journal? That's what the headline says. It says it right there. They're falling. It either happened or it didn't.
But they have year over year, right?
According to Redfin, that's my point. A long time ago, I used to. They're not.
So two things can both be right. There can be rents are rising today, but they have also declined year over year.
Well, that's the thing, is that they're not, that by characterizing this as a blunt fact and not just the result of reporting from Redfin, I think that some of these I hate the word mainstream media, some of these media outlets are mischaracterizing what is really just one data point among many, and one data point that is not that's an outlier.
Yeah.
So I would say it's wrong in the sense that if you're going to not cite or not just say like Redfin reports this, is that maybe too much to ask the editorial department.
I think the issue is we're making commentary on the future by using data of the past, and what's happening today isn't really indicative of what has happened. There could be some indication that maybe we're going to have slower growth and maybe some declines. But we track this as well, Matt. What are we looking at year over year?
Yeah. So, along with citing your sources, which those headlines didn't really do when they mischaracterized the rent growth numbers. Another thing I told an old college writing class I used to teach was to look for more than one source. Don't just Google your topics. Dig in. Don't just dip out after you find the first source you find on Google. You can, and especially when it comes to apartment rent growth, there's lots of rent growth trackers. Some of these we've got a lot of data on. Up to like September 2021, really emphatically, there is more than one source on apartment rent growth, and Redfin's measurement of rent growth is a clear outlier. Really looking at
what do we have what our year over year on the aggregate is? The average?
The average. So if we're going to look, it's that dotted pink line, and the average is, if I can click on here. There, let me see. If you hover over it, we've got, where are we here? Well, let's just go into the chart itself here. And the actual number that we have for average rent growth is, for March, the average is 4.24 if you're including the CPI, or 3.95. Or that's 3.59 if you're excluding the CPI.
That's year over year rent growth?
That's year over year rent growth. So a far cry from negative 0.4, whether you're factoring in CPI, which is going to bump it up artificially, or you're throwing that out, which leaves you at about a little over 3.5% rent growth year over year. Now, going back to these numbers and really actually not just the year over year, but really looking over the recent month over month rent growth, that you can find that Redfin is a clear outlier, or at least it's clearly volatile compared to the other ones. What's that line that's jumping in and out of what is otherwise fairly grouped together set of rent growth trends? Yeah. That is Redfin. It's going, it's dipping down low and it's going up high the next month.
So there's much more volatile.
Yeah, much more volatile.
A little more volatile.
A lot more volatility here. And the year over year numbers maybe don't have Redfin standing out that much, but looking at 5 different rent growth trackers going back to September 2021, like I said, rent growth had the highest year-over-year rent growth, spiking up to over 21% in November 2021, which is is a little high, but it also is now at the lowest. So it's the higher highs, lower lows.
And I was asking this. It doesn't mean it's wrong, but could it be more accurate that it's just a higher they're using higher frequency data, so they're getting their data, it sounds like, from rent.com. They call it rent.
I have asked Rent on LinkedIn, do you pronounce it rent.com? Do you say in the office, hey, it's great to work at rent.com?
Or rent.
Or is it rent? Or is it rent dot? I think it's rent dot.
Oh.
I know. I asked them. They did not respond to me. I think that they're self-conscious.
So there's no comment?
I think they're self-conscious about their name and they don't like it. But that's my hot take of the day. Even more hot than the Redfin, because I don't think that the Redfin should be thrown out. It should just be used in context with other ones.
Yeah.
And if you know that it's a little volatile, then maybe then you can kind of account for that, or you can look at some valuable things that are actually in the report. And going into this report, you can find actually they used to have what I'd like Redfin to return to is they had home ownership costs alongside the rent growth numbers, so you can kind of track both of them. But for some reason, it's not in this report. I'd love it if they put it back in. Anyways, they have numbers for specific markets as well, and their declining markets are Austin, Chicago, New Orleans, Birmingham, Cincinnati. Some of them share with other rent growth figures.
Oh yeah, yeah.
But other ones not so much. Here, I'm going to give you the reins here.
No worries.
And what interested me wasn't the ones necessarily that it shared with people. Like Indianapolis, it's high. It's up there for great rate growth markets for Redfin, as well as Yardi Matrix, CoStar, Apartment List. That's great. But what about Chicago? Chicago is actually very nearly the opposite. Redfin has Chicago at negative 9.2% rent growth. It's pretty much, again, directly the opposite about from other reports. Yardi, Apartment List, and CoStar have Chicago among the top markets for rent growth, very much not the bottom. So there's stuff to get in this Redfin report. There's completion numbers. It's kind of like, take it with a grain of salt. Don't throw it out, but know that this is the Redfin numbers are going to be a little bit more extreme on the higher and the lower end.
And even this conversation is that, just be careful, I guess, when you hear it, see a headline, to really be certain about what that data point is they're talking about, what the source is. I mean, year over year, month over month. I mean, median. There's so many different ways to look at any different metric, and especially rent growth. Depending on the source and the time frame, there's a lot of different choices. And Matt, your concern is there's a narrative. That's what I was getting. That's being pushed.
We know it. We know to look at things like month over month because they may be more valid. It may give you a wrong, mischaracterize if we're going to go year over year right now, just because we're comparing.
But people are asking, are rents up or down? Is real estate good or bad? We have to be like boiled down and simplified to like really good or bad. Is it like people real estate going up? Is it going down? And the narrative is it's going down. And that's why this has been picked up on. That's the narrative that the media is pushing, for right or wrong. There's plenty of that's certainly could be correct, and there's certain things that are like, well, you're not really getting that full picture. But and again, we've talked about it. We've been talking about this a lot, but the frequency that commercial real estate is now brought up on the national financial media is it's a lot more today than it has been in the past. I mean, very frequently. I mean, the question that someone's coming on to talk about macro, they're talking about commercial real estate and the loan expirations that are coming due. There's a ton of maturities. We were looking at the data yesterday, Matt. I mean, October of this year. There's a big wave coming, and then there's the early 24. A lot of loan maturities, and there's a lot of areas of commercial real estate, especially office, that are going to be in trouble, and there's going to be some multifamily operators who are in trouble.
It's interesting because it's in those kind of conversations that you'll see some talk about multifamily, but a lot of the coverage too, when it's talking about rents, there is a tendency to, lower rents are great for most of their readers, basically. Most of the readers of a mainstream media, of a CBS News article, are not going to be multifamily investors, and so they'll see rent growth as a good, which is fine. Just it's a different perspective.
But now I think it's moved beyond the content for multifamily investors or renters into a macro narrative of the economy.
It's going to wreck the banks and stuff.
I think it's really not. They're not worried. They are not worried for the owners of commercial real estate. I don't think that's the concern. I think that the worry is that there's going to be a fallout, and that we kind of narrowly got past this little banking kerfuffle of. And there's a lot of uncertainty. Just what happened? We had this little bank failure that happened a month ago now, and where are we with? What did we learn? Are there ripple effects or not? Are they under the surface?
I don't know.
We don't know. We're
planning on making a segue, but this is like the most beautiful segue I've ever seen to the next.
I've been known for being able to do that. So anyway, where is distress risk in today's CRE market? Marcus and Millichap just came out with this, Matt. I'm glad you brought this up. It's a good question. It's a really good question. Where is the distress? Where is it? I mean, I've heard of some foreclosures. It's articles.
And this is a video, so we don't really have to go over it specifically. But Really, it was another excellent take, and it jibes well with some of the a lot of what we've been saying. But I think it bears repeating for the very reason that you've given too. Is like, this is in the discussion, and if we don't keep repeating ourselves, then that's going to be taken over, I think, by some things like mischaracterization.
Yeah, so the narrative is being driven now by journalists,
yes,
who are not necessarily experts,
so
in the field, and they're more writing articles to get views and clicks, and talking about a wave of debt and real estate crashing. Is a great way to get people. I mean, fear engages people, and it drives people, and they can paint a lot of fear. And so, but it's not that there isn't truth to some of these concerns. It's the stuff we've been talking about, Matt, for the last year and a half. But
I appreciate people like John Chang and Paul Fiorillo and Jay Parsons really lending their voice to this, because otherwise, it could kind of get lost in the doom and gloom, when really you got to kind of qualify the threats, because they're out there. And John Chang does say that they're out there. It just doesn't threaten banking as a whole. And that's kind of his big point is, it's not going to tip over banking. However, there is some threats, specifically, like we said, in the office market. There's isolated incidents. He also references the Houston owner or operator that had to there was like thousands of units in foreclosure. Again, isolated incidents, but those instances were caused by floating rate debt and really high loan to value ratios. When and he shows in this video, loan to value ratios are ever lower now.
I've seen that statistic floated a couple times, and while that is true, that is true. That doesn't mean at the early part of the period where a lot of these loans that the LTVs were, now that the basis maybe have been a little bit better, you're still getting kind of 75% LTV, maybe even higher in some cases.
And I wonder how that shakes out for each sector, because I think they're lumping in all the sectors. I think they came to like 53% or something now.
And that makes sense. But just looking, and another discrepancy, Matt, that we've talked about is that the different groups that track this information, there's different numbers of how much debt is outstanding, and I'm sure they're tracking different. They're tracking different things, but MSCI has $900 billion total over the next 2 years, but the Mortgage Bankers Association (MBA) has $1.4 trillion, and of course the media is going to talk about the $1.4 trillion rather than the $900 billion. But there's a lot coming due either way. This year in 23, either $400 billion or $728 billion, and then 2024 it's $500 billion to $659 billion. Take your pick. It's a lot coming due, but not all of it's going to necessarily be so distressed. Some of it will work out, but
there will be a slight cumulative effect of every single person that has those isolated incidents where they made the wrong decision. That's going to a little bit kind of mark or affect the market in some way and push maybe prices in a little bit more reasonable place.
Exactly. But the question is, I mean, there's going to be some consequences, and it may mean that owners are not losing money, but they're not making any money, and they have to kind of hand in the keys. Maybe they get their money back, maybe not. And so I think the banks are going to be in a relatively good position, because they still have these assets. If they foreclose, they've got these assets that that they should be able to sell at some point. But there's definitely going to be some investors that lose money. Without a doubt, and we're already seeing, from like you mentioned, Matt, there's already foreclosures that are taking place. I don't see a wave of foreclosures that has occurred, but I think later on in the summer and by fall, I think by October, when last time I was looking at the CoStar data, we were looking at it yesterday, there's a big spike in October of 2023.
What I'm curious about, so you've talked about banks coming in and owning these assets.
They don't want to.
Kind of don't want to. But so then, that's what they said. I know they're starting to become experts at multifamily. But does that mean that banks would be a little bit more amenable to
working something out? If they can. In some cases. Here's this Houston apartment owner loses 3,200 units to foreclosure as multifamily feels the heat. Sorry, Matt, your question was.
So would banks sell Would banks want to sell it? Would they be easier sellers than the actual people?
I think it all depends on their own balance sheet and what their liabilities are and their capabilities to manage. I think some may say, and what their exposure to it is. Some of them may say, "Hey, let's just get rid of this thing, and we're gonna take it to a broker immediately. We're gonna sell it." Some may say, it might be worth to hire an asset manager. But the bottom line is banks aren't in the asset management business. That's not the risk profile that they take on or that they're even capable of. They're not property managers. They're not really asset managers either. So they don't really want to be in that position. Some, I think, will make the attempt and can outsource it. But I think it's going to be who the investors are, or who the ownership is in the bank, what their liabilities. I think it's going to be very individual basis, what the relationship is with the borrower and the bank itself.
I'm just wondering.
So I don't think it's a blanket. But prior to last couple months, it was typically, the banks are going to want to take it back. They don't like taking it back. But now, we saw again really sprung by the whole SVB and some of the regional bank issues. If they're in a tight spot, they're not going to have a choice. Like they may have to. Or I've talked to some lenders who are like, no, our investors. And this is more like the debt fund side. They want those assets. They don't really want to work with anybody.
Okay,
we'll just take them.
And that was my question is, would there ever be a situation where someone is trying to sell, the price is too high, they go into a foreclosure, the bank owns it, they go back to sell it, and they're like, well, we're not going to sell it for as much as that original guy. And
exactly.
I'm hoping that that, but it's again, that's a lot of decisions that need to be made. That kind of extends the timeline.
And you would think that the bank is that they're having to write it down on their books in some ways. So someone's giving them an idea of the value. Now again, price discovery, not really sure where values are right now, but they'll probably go in the middle somewhere of any recent transactions. But then at the end of the day, it's got to go to market or got to go to auction. And it all depends on how motivated the banks are. Could you see auctions? Sure. I think to get a price. There was an auction last year, but
really?
It wasn't like it was. It was a distress situation, but it wasn't related to any of this. It was more of that was more execution.
So that's how the banks do it, is auction. It's not a broker.
Well, the brokers would run the auction.
Oh, okay.
Typically, they'd go to a broker and they'd like, let's get this thing sold. It would be a similar process, but the bank may say, we have to get it sold. All right, and so an auction always is an option.
Yeah. Interesting. Very interesting.
Deals.
But,
that's the bottom line. So it's, are you prepared to weather the storm the next couple of months? The Federal Reserve most likely is going to raise Fed funds rate another time, 2 or 3. Who knows? Maybe not more than that. We don't know. So we're looking at a 6% Fed funds rate. Halfway through this year. Getting into third, fourth quarter. Can your assets survive that type of debt service coverage if you're on a floating rate loan? Or if you're on a fixed rate loan, you don't have to worry. All is good. But if you're on a floating rate loan, can you get through?
The longer it is, the harder it is.
And then get to the other side, because there's going to be people are going to get desperate. And they're going to hold out as long as possible. But it's not. I don't see I think the screws are slowly tightening. But I think every day, every week, every month, every Fed meeting. And then I think the closer we get to October.
That's what I was going to say. People are going to want to get in before the wave. So that may motivate them. Like, all right, I'm not going to wait till October. Now, if they could collude and all time it at the same time, they would do that. But no, these are all individual people. They all want to get the best price. And I wonder if there's going to be some early wave.
Well, to get the best price, you got to get sooner rather than later.
Yeah, exactly. That's what I mean. Yeah. So and I wonder if there's some earlier sales.
I think those owners, most people, and a lot of this there's a lot of options. You can be creative, and I think they're trying to work it out. There's some people that have the money that they can just, hey, I can put the money in the deal. I can float us. Like we're all gonna have to bring cash to the table to close, to refinance, but I can do that. I can write a $1 million, couple $1 million check. Some people will be able to get maybe an extension from their lender. I can see if there's a lot of no, these are good assets, these are good borrowers, these are good operators. let's just give them a year extension.
Yeah.
And they'll probably, pay for that. And, so the bank's not going to do it for free. But none of this help's going to come for free. But there's going to be some, it's not only going to be a, handing the keys, kick you to the curb.
Yeah.
But there's already some of that's been going on. And there will be some of that because it's amazing. Some people aren't good at communicating and they're not going to talk to their lender.
Well, and I was also thinking for as much as they're going to wait for the last possible moment, this is a situation where I think quick decision making is also going to benefit buyer and seller as long as they have a good idea of what's out there. It's better to decide now and get ahead of things than maybe risk lower prices.
What's so tough, Matt, is that when you're looking at a potential, like a refinance or rescue financing, it's, do you make the decision now with the information you have?
Yeah.
Or do you gamble and roll the dice on rates being lower?
Yeah.
6, 8, 12 months. Because the idea being, if we're going to see some sort of fallout because commercial real estate's going to, hit a rough patch, there's going to be we're going to go into a recession. Rates are going to be lower. Why not refinance at a lower rate?
Yeah.
In a much more favorable environment. Not that the recession is going to be in the favorable environment, but I'd rather be paying, 3.5 or 4 rather than 5 to 6%. And I think there's risk in the indecision and there's risk in waiting. It all depends on what that maturity, looks like.
Yeah.
And then the opposite could happen. Rates could go up. I mean, Fed funds rate's going to increase. Now, the 10-year and some of the other longer-term loans, all depending on how you're going to finance it, they've been coming down recently. I think they popped up.
Well, and there's a Charles Schwab article that gets at this very, very concept.
Oh, let's take a look, Matt.
And they may disagree with you a little bit on where we are in terms of the Fed rate hike cycle.
I don't know.
According to this Charles Schwab article, maybe we're at the top of the rate cycle, and top is good here because
look, she's topping out
because that means that we're on our way down. Really compelling, I think, cogent explanation.
No, I mean, but that was the point I'm making.
Yeah,
is that if we're at the peak, why would I want to lock in that rate now?
Yeah.
When rates are going to be lower, maybe in 6 months to 12 months. If you have that type of flexibility, and these are the conversations that people are having right now. Do you completely take the risk off the table, but you're basically buying high, but minimizing risk? I mean, it's really it's a risk management question.
Yeah.
Sorry, go ahead, Matt.
This really illustrates what I liked about the Charles Schwab article is it illustrated the real drawbacks of the Fed's trajectory now and in the past, most of a year. The lead is Schwab's claim that we won't see any meaningful increase in the federal funds rate, which is a bold hot take I can get behind. I also appreciate how they back it up with their account of the current state of the economy. A big point right now is that the lending environment is dismal. Schwab didn't throw in the inverted yield curve for nothing. It's been inverted for 9 months and it isn't exactly news, but Schwab puts it in here as a sign of how close we are to recession. It's not great, and the Fed got us here. There are details that Schwab provides to make its case. There are additional details that the Fed will stop hiking rates, including some very necessary comments, I think, on inflation trends. And the quote is, even though core inflation has taken longer to decelerate toward the Fed's goal, we think the recent banking stress and tightening in credit conditions will act as a strong disinflationary, if not deflationary force. While that bodes well for the fight against inflation, it also reflects the risk of overshooting to the downside, as deflation is often consistent with recessions. For that reason alone, investors should be careful what they wish for when it comes to a rapid decline in inflation metrics. The subtext of Schwab's article could be encapsulated in the last part of that passage, in that investors need to be careful what they wish for when it comes to rapid decline in inflation metrics. Declining inflation means that people are paying less with lower economic activity. So extending that idea, the Fed's drawdown of interest rates will be motivated by economic conditions that will be dismal and will be painful for a lot of people. I would be among the majority in saying that hopes for a soft landing are kind of non-existent. And this article seems to be making the argument that in order for the Fed to land the plane at all, it needs to be a bumpy landing. There needs to be some pain in order to get to lower rates.
You know what's good though, Matt? Mm-hmm. We don't talk about a crash. We're talking about landing the aircraft.
Yeah, that's true.
I will take a bumpy landing, and just as long as there's no
as long as we get there.
Crash, like a landing is a landing. I mean, sure, you want it to be like smooth. Like, did we even land, or we're still in the air?
Yeah.
But if it's you come down, you crosswind landing, and you got the aircraft.
Well, that's why we have that.
Well, how else are we gonna simulate?
Exactly.
You come down and it's a little bounce. So, sometimes you can't avoid that. To an extent, but it's not.
Put it in the hangar.
It's not a crash.
Yeah.
Good thing we're able to use the prop.
Yeah.
But Matt, so basically we're gonna have a recession. It's past due. It's a certainty beyond certain. Man, that mean we're not gonna have one?
Oh, that's a good point. They're saying it, so now they're jinxing.
Just anytime anytime is so certain about
we've
something.
Swayed in and out of the possibility of recession enough for at least and I think you're right, it deadens the no one's talking about a huge crash. As much as they're not talking about a soft landing, they're not talking about a huge crash. And that's, I feel like it's going to be in between contraction, recession. That seems to be what the narrative is.
Maybe we need to come up. You know how certain Inuit peoples have there's how many words they have snow?
Yeah.
It's they've got more than dozens of words to describe different types of snow. Mm-hmm. Now for us, for all the work in the soft sciences of economics, we've got stagflation, we've got recession, we've got depression, we've got slowdowns. We don't have enough.
No, we should.
I don't think we have enough because I don't think whatever we're in is stagflation.
Hey, they've got Category 5 tornadoes and hurricanes. Maybe we could get a category 1 recession.
Yeah,
that's maybe the lowest.
Yeah, I don't know. Choose the cape. News asides. Matt, I just wanted to pull this up because it's illustrating. This is the forward curve for SOFR. Let me triple check. Yeah, it's got the 1 month SOFR, 3 month term, and 1 month LIBOR. I'm just going to go to 1 month SOFR. So the reason why we're looking at this is because this is the rate that almost all floating rate multifamily loans are based off of. And this is information based on the futures market of bond traders and people who are buying and selling caps and swaps and other basically hedging instruments. That's what Chatham Financial does for related to all kinds of different securities and investments relative to SOFR, or you can just trade the stuff. Anyway, a lot of different pricing action, and it basically predicts where traders and investors believe, where are they basically saying that the rate is going to be.
So there are investors that are making investments that are saying it's going to be at X value in 2025 or whatever. And that's what this kind of represents?
Correct.
Okay.
And that's what the forward curve is. And so right now, and it doesn't mean that it's right, but it's been more correct than most. Today, so in May, they have, it bumping up to 5, the SOFR, which is usually very close to the Fed funds rate. But basically, as soon as August, we've got SOFR starting to decline relatively steeply. And by, February of 24, we're at, we've gone down 50 basis points. And by, December of 2024, we're looking at SOFR close to under 3.25.
Yeah.
Now these are the dot plots from the FOMC, Federal Reserve members. So the FOMC members for just, for January 2025 have the potential rate being much higher, significantly
over
higher.
4, is that what that represents? The blue dot
the blue, correct. Blue dot is the average, but this is the range.
Do you think that the
entire bond market is making no? But this is like a recession happening.
Yeah.
or so,
Yeah, exactly. All these
a recession or a significant deceleration in inflation.
It doesn't,
which typically is caused by some sign of down, the economy going down.
And what I think is, I wonder if the dot plot is a little bit of like they are wanting people to think that it stays higher for longer. There's a little bit of motivation.
Yeah, absolutely. I mean, we talk about this, the tool of psychology, the Federal Reserve. I mean, what point other than that does this serve?
Yeah. Mm-hmm.
Other than to frame expectations to the investment community elsewhere.
Wow, I think that's it seems pretty valid, and it definitely lines up with what Schwab's article says. Is like we're about near the peak, and like what you said, there's gonna be some pain that gets us there. Not that we haven't had enough pain, and it is funny talking about this. We've around the pandemic, and even during the last few months of it, there was inflation, but it wasn't like we were having incredible boom times. There was some economic disruption, and I'm hoping that the fact that there was economic disruption, there wasn't like a golden age that we were just ramping up and up inflation. Maybe that will deaden any future recessions. But whatever, millennials could take it. We've been through a lot.
Yeah. It will. We'll be fine, right?
Yeah.
It's all will be good. I mean, you have to be optimistic in these scenarios, especially you have to assume that the fog of war, further, discounts, the market, and just the uncertainty and volatility, just increases that risk profile, and I think that it makes a lot of sense until we have some more certainty. I think that we're going to be narrowing in uncertainty in terms of rates relatively soon once the Fed pauses, maybe, but along with that type of certainty, more uncertainty could come from potential disruptions in commercial real estate or elsewhere. I think that commercial real estate could be end up being a distraction and not as big of a deal as some are making it out to be. And then I just think that there's a lot more risk taking in other parts of the economy. And again, we've had some crypto blow ups. Obviously, FTX already happened, but I don't know if there's anything, if it's crypto or technology related. A lot of that's already been fleshed out, but I think it's a time to look for opportunities, get expenses in check. I mean, that's one big challenge right now that we're seeing, not just in our portfolio, but just talking to other colleagues, is that just expenses. We're starting to really see those rises in material costs, and turns are more expensive. And so you have to be strategic about maybe not doing, at least what we're trying to do right now is maybe the way things have been done for a long time isn't the most efficient and best way to accomplish the tasks. And so just having to be really creative and be, how can we use technology here to, manage assets more efficiently and do a better job, but cheaper, because you have to reduce expenses. Expenses in some areas are growing 20-30%, and rent is no longer growing. There was a brief period when rents were growing that much, but in an ideal world, it's we're growing at 6-7% in the Midwest right now. It could easily go down to 4 and 5%.
I wonder
averaged out
if there is a little bit of a lagging period. So we saw inflation again late 2022. That was kind of more or less peaking, and now you're getting the turns are starting, and so now you're actually seeing a lot of those increased prices where you weren't spending it right when it increased.
It's true. Everyone was staying put. Yeah,
and then the rent growth is a little bit more normalized to put it bluntly, but so that can't as much support it, so it maybe feels a little worse too.
Yeah, I think I think it is a lot more just normalization, and but we're not just normalizing back to 2019. I think we're normalizing into an average of the. I don't think we know. I don't know what we're normalizing to, but it's at least right now it's not like 2018 or 2019. But that doesn't mean it's like 1986 or 1993 or 2008 or 2009 either. I don't know if it's any of those. because and again, we're in Indianapolis and Midwest where we're still seeing rent growth. We're not in Austin, Phoenix, so it's that there's the whole someone's taken the table and flipped it up, and all the pieces are still in the air, and until they all land in place, I'm not gonna be able to say what exactly things look like. But that's why get back to the basics, control expenses, manage your assets.
A year of thank you, Mark Zuckerberg. This is the era of efficiency. If he hadn't invented that, I don't know if anyone would be as efficient as they already are.
What did he invent?
He invented the phrase "the year of efficiency."
Is that what he?
That's what he said.
That's what this year is.
That's what this is for me.
Yeah, it is true. Kind of.
I know.
But I mean, technology, it's like a whole other animal. That's like how would we operate without like masseuses and free sushi?
I know. Yeah, we're very good point.
And that's their efficiency.
But that's the thing is,
if you're used to the sushi.
if you're not in that mindset where you're kind of like, oh wait, let me take it. What are we spending money on?
Yeah.
Then it could be a free sushi and masseuses, or it could be maybe we're shellacking our tubs for too much to use a more specific example.
What is that?
Like sealing the tubs. I don't know.
Shellacking the tubs?
What is it? Shellac, polyvinyl.
Caulking?
Yeah.
Oh, sorry. I thought you were still talking about Mark Zuckerberg.
No. I'm telling you, maybe in the tech world, it's masseuses and sushi, but in the multifamily world, maybe you're applying one too many coats of paint. Or maybe, or maybe there are other flooring decisions that you could go with maybe a slightly more cost efficient.
It's all that, and it's like, okay, what look at your vendor relationships, and what are you contracting services out? What are you doing in house? You sharing staff, and then what kind of technology are you using? Do you have subscriptions you don't need? Do you have technology that you don't need, or is there technology that you could use that could replace other systems? Or can technology replace a person, or can one person, float into the job of, a couple people if you have the right person in there? So I think it's everything in anything. And, I don't think we ever had free sushi or massages. That we've had some lunch, team meals and lunches and things like that. But I
don't know what you do in a tub. Do you shellac it?
No, you don't shellac a tub.
You don't shellac a tub. You know what I'm saying?
Matt is not involved in the maintenance at our properties.
It's not that part.
No. No, but that's okay, Matt.
I did try to do a segue here, and now it's going to be a little bit less.
That should be the clip.
Yeah, that's right. I know. We'll put that in the clip. We're going to clip that out and use it to advertise the great report. That's fun. There is an apartment list article. I mentioned as a way of a segue that millennials have dealt with their fair share of economic crises, and I'll throw in Gen X too. But it really has taken a toll, I think, on their attitudes toward home ownership. And this apartment list article that came along is it really shows how there is a kind of generational shift, not only between the millennials and previous generations, but generation upon generation, there are less people that are owning a home. Now, we have reached the milestone where now more than half of millennials own a home, 51.5. And, you can see other generations, obviously.
So the first millennial that owned a home was in the 90s.
I don't get.
So how old was that? So they were like in their teens?
I guess so. Maybe maybe the millennial thing starts when the very first millennial turned 18. That's when this millennial trend line started. But
it's home ownership. Because it should be when they started maybe recording the information, it was below 20. It was like 18%. So in 2000, which the millennial is what, like 19? Does it define
81.
millennial? 81. Maybe. So 19 years old. So okay. So in 1990, whatever, 98, in 1998, so the oldest millennial would be 18 years old.
Mm-hmm.
Yeah, but this including everyone, also the like 10-year-olds and.
Oh yeah. That's a good point.
So 18% of all millennials in 1998 owned a house.
Yeah. Well, and
I don't know.
Don't
look at that part of the graph.
Yeah. But that does explain how, as a generation gets older, their homeowner ownership rate tends to increase. Now it flattens out, and the silent generation now owns slightly less homes than the baby boomers. But again, the general trend is
they've moved into a home. They no longer own their home.
That's a very good point. And maybe that could be the trend. Now, if you normalize this, if you kind of compare apples to apples, at age 30, 42% of millennials were owning a home, 48% of Gen Xers, 51% of baby boomers, and 60% of the silent generation owned a home. So as each generation comes into home ownership years, they are owning, less and less of them are owning homes. They give plenty of reasons for these generational gaps, especially the ones with millennials. We've got the Great Recession. We've got scarcity of starter homes in cities. We've got persistent, I think, affordability challenges for the last 15 years. Yeah. COVID did not help things. It increased this gap between millennial homeowners and renters.
I mean, it's a big dip for Gen X recently. I don't know. I wonder why that is. They think some decided they wanted to live in apartments.
Yeah, that could be. I know that.
Oh, they're getting divorced. Oh, some of them got divorced. They moved into apartments.
That could be. Well, what's interesting is that millennials have a dimmer view at the current moment of their ability to own a home. So 24% of millennials think, well, I'm just going to be a forever renter. 20% of Gen Z people think that they're going to be a forever renter. It's almost like as they get older, they realize and they come to the hard truth that this it's not worth chasing down a home, paying down that home.
I mean, it's a huge shift between 2018 and 2022. It's only 4 years, but to go from 15.3 to 24.7.
Yeah. And the jump, and that's good. So it shows that increasingly millennial renters are giving up on home ownership from 2018 to 20. Every single year it jumped up. And the real big jump was when the pandemic started, jumping from 14.9 in 2019 to 21.
And this is people who plan, this is not the people who say well, I would like to, but
very good point.
But this is no, my plan is to rent. I'm not planning on buying a home.
Yeah.
Not like, oh, well, I'm trying to figure out how to buy a home, but it's not an option right now.
Mm-hmm. And so, subtract that. It's about, 76-ish, 75%, plan to own a home.
Yeah.
But for those who are choosing to rent forever, they're not deciding because they really want to. It's because they can't afford it.
Which, it's kind of interesting. It sort of correlates to this number of baby boomers of around, 3/4. Do you think that the quarter of baby boomers don't want to own the home? Or is it? I don't know if there's any correlation, but it is kind of close. But here's some of the reasoning, for millennials who will rent forever. So this quarter of whatever millennials. Why?
Can't afford it. And
can't afford to buy a home.
More now than, a little bit more than in 2018. So post-pandemic, it's gotten even less affordable.
And a lot of this is desperation. Maybe these people if they ask, I think you could ask this question so many different ways and get different answers. Would you like to own a home if you could afford it? If you were given the money, would you buy a home or would you rent?
It's not choosing, it's giving up.
Yeah.
And that's a little bit sad, but I think it reflects the conditions that are just battered.
But I like the flexibility that renting provides. I mean, that actually has gone down, and so it's really shifted to just affordability. In 2018, people were like, "Yeah, you know what? I kind of like renting. It's flexible," which is definitely true. That has to be a COVID thing. Also, people aren't moving around as much, maybe, and they're like, And then there's I can't afford it. I'm just frustrated. I prefer to avoid home maintenance and other added costs. Sure, I can see the appeal there. In 2018, it was 36%. 2022, it was 26% again. So it seems like people are just that's all great, but really, it's a money thing.
Yeah,
bottom line. Everything else is just
What's super interesting is now again, if they plan to buy, affordability is still the largest hurdle. It's very much
it's the down payment.
Kind of similar. Yeah, exactly.
That's the hurdle. What's the biggest obstacle you face? It's the down payment.
And this figure in the very next chart here, really, I don't want to say gives it away, but 67% of millennial renters have no down payment savings. Now, I don't know how that lines up with the people that have chosen to be forever renters, but it's more than that. So 67 minus let's say 24. What do we got? I don't know.
It's kind of inverse.
Yeah, yeah.
There's like 70. There's 3/4 of people who like want to buy a home, but about 67%, so a little less than 3/4.
Yeah.
Let's say not. So there's only a fraction of those people who are planning to buy a home are actually saving. So it's like, again, you're taking like that quarter, but the 3/4 that say they want to buy a home, like it's not going to be an option.
Yeah.
Unless they're getting some help from somewhere, but like it's not in the cards. Like you need, what's the average down payment? Yeah, they've got zero money saved. Now you could do a 3.5%, FHA loan, 3.5% down, or you can put less than 20% down. That is an option. You're paying, mortgage insurance premium when you do that. Not necessarily bad, but just it is what it is. But $0, you got to have more than zero to hit that 3.5. Let's say. Again, this
zero means also it suggests that they're not planning yet to. So there may be 40%, give or take. There may be 40% of millennials say they plan on they don't think that they're going to be forever renters. They plan on buying a home. They have done no saving to do it.
Yeah, $300,000 home, which depending on where you live, you're going to be buying. That's not even an option. You have to pay way more, or you can find a cheaper house. Like in Indianapolis, you can find a house cheaper than $300,000 for sure. Really hard to find in some work, but they're out there. A lot of them. They exist, but they may not be for sale. That's 3.5%. You get an FHA loan. That's still like over $10,000.
Yeah.
And that's not easy to just scrounge up for a lot of people.
Oh yeah.
And if you're putting down an actual 5% to 20%, that's.
It's hard.
It's hard. It's $60,000 all of a sudden.
Yeah,
for 20%.
Just to start that, it's going to be a significant undertaking. This story is still developing in a very big way.
And it's always developing. This is the dynamic demographic story that as multifamily investors, real estate investors, we constantly have to have the pulse of and know that this is where the wind is blowing for the future. And it could be hard to make. And this number can move around. Like the home ownership rate can fluctuate. It was up before the Great Financial Crisis, and then it dropped during the Great Financial Crisis, and then closer to 2018, 2019, the home ownership rate started really kind of picking back up again, and then it shot way up during the pandemic, and now it's come down a little bit. So it can be volatile, but the overall trend, at least right now, is that renter nation, for better or for worse. We're moving towards a society where most people rent their homes, like is the case in many other parts of the world. The parts of the world could do things differently. They don't have multifamily. They have apartments, but they're not managed or built the way that we do it here in the U.S. for the most part.
Yeah,
it's interesting, but the fact is most people rent. It doesn't usually make sense. To make, again, this is a whole other topic, Matt, but other than some emotional reasons that can be strong and good reasons, but if you're purely looking at it from a financial perspective, there's no real reason you need to own your own house. It's one way to do it, but most people are only going to be there for a fixed amount of time, 3, 5, 10, 15 years. And
I wonder if
a lot of,
the mobility of remote work plays into a little bit of this. Probably doesn't, but
it's definitely a factor.
Yeah. That's the other big change that I feel like is happening in American culture as it pertains to commercial real estate is this remote working and this housing affordability, this shift in American value. Because going again at age 30, 60% of silent generation, 51% of baby boomers, 48 Gen Xers, 42% of millennials at home. That's a big shift. Oh, I'm glad that you found this graph too. These are the markets, and they are ranked by percentage of millennial ownership by metropolitan area. And the lower cost of living places, almost all of them in the Midwest, are the leaders of the pack here.
It's not shocking. Anecdotally, man. And we know, again, we're from Indianapolis, so we know the Midwest, and especially Indianapolis. I know a lot of millennials who own their own home. Not all of them, but I know a lot.
Yeah, one of my friends was talking about, like, he travels, he's got a job that he has to travel all over for, every other weekend. He's like, listen, I was thinking about moving somewhere else, but Indianapolis, one of the big things is low cost of living. It's there are great things around the city, just like any other cities, but it's such a bonus to not have to spend, your entire paycheck on a mortgage payment.
Yeah. No, it is nice. I mean, when we bought our first house, and it was $250,000, and we moved out because we ran out of space, but like it was awesome.
Yeah,
and like there were those available. You used to be able to buy a house for under $200,000, like a starter home. It would be an older home, maybe you need a little bit of work, but $150,000, can get you a decent amount of house.
Yeah, and place so the top here of the most affordable is Grand Rapids, and followed by Minneapolis. That we've talked about that. Cincinnati, St. Louis, Pittsburgh, and then Indianapolis. Those are the top 6. Interesting. What is it? Number 8 is Salt Lake City. At their home ownership rate is about 55%. Now, that's millennials too. Again, the national average is 51.5, but it's good to see, some of these lower costs. It just makes sense that.
But there's only a handful of markets that are really above the median, because there's
that is
a handful.
Really interesting.
Like Grand Rapids is like, almost like 75%. It's like almost shockingly high.
Yeah.
And then the rest of the Midwest is really kind of sticking out there a little bit. But then, you've got like places like L.A. and top the bottom for unsurprisingly are California, followed by New York. Memphis is a little surprising, I guess. Honolulu certainly isn't. Miami isn't. But Los Angeles. It's in the 20s, mid to low 20s. So it's interesting. And
what another thing too that's worth another reminder here is that housing prices do tend to go up and go down in tandem. I think home ownership prices are diverging a little bit because of mortgage rates, but when it all kind of boils, if mortgage rates were not a factor, there may be a little bit different, but again, they are a huge factor, and they're driving people, I think, out of home ownership.
Yeah, it's just it's poured cool water on the market. There's enough buyers out there that the prices are staying up in many cases. Like I just saw a report in Indianapolis, single-family homes year over year, prices are still up.
Yeah.
Not a lot of inventory. There's still buyers in the market.
Yeah.
So
it's very interesting. And then, there may be a alternate path to home ownership for Gen Z, but I just think there is this clear shift of generation to generation, decreasing rates of home ownership. Who's to say maybe Gen Z only 20% compared to 25%. Only 20% of Gen Z people think they're going to be forever renters. Millennials a little bit more jaded, a little
Gen
older.
Z doesn't think like the whole world's going to be here in 5 or 10 years.
I think that's true.
I think a lot of them just they're writing it off. Yeah. And then totally, they'll figure it out. When you're teenager, late teens, people it's almost like, oh wow, these Gen Z teenagers, they're really kind of edgy. And I'm like, hey, what do you think teenagers? What do you think teenagers have been like?
I know. Yeah, ever like Roman times. There's probably some ancient tablets that say the same thing. Maybe they're talking about home ownership rates. I don't know, but
I went through the frickin' obviously I didn't, but like late 60s. The whole cultural revolution. They're like, we've seen kids have dropped in and dropped out in much larger scale but before, so and then become the yuppies and they all just get a job.
Well, and my point is, I think that these numbers, just like they did change for millennials, where millennials got increasingly more jaded towards homeownership, I think that Gen Z will get increasingly more jaded towards homeownership.
Yeah.
And the cumulative effect from generation to generation, I don't think it should be ignored. And I think it stands to benefit multifamily investors, or at least the performance of apartment properties.
But I would like to move away from, because sometimes I think these statistics get framed in a sense of these generations are missing out on wealth building opportunities. And because it is true that one of the primary ways that individuals build wealth is through ownership of primary ownership of a single family home. But that's not the only way to get there. That's just been like the tried and true method that your dad and your grandfather and everybody has done. But there's a point that doesn't make sense, and it's certainly not the only route to generate wealth. I mean, at some point you can separate, and we've talked about this plenty of times now, we can separate the need for the utility of a house in a place to sleep and do whatever you need to do with your family and all that, and then also a vehicle to allocate your capital towards, and from an investment standpoint and from pure economics. And again, it's a process of evaluating what your goals are and what you're looking for in life. And maybe owning a house is one of the primary ways to achieve that. I want to be able to have a certain lifestyle and to control my property. And in order to do that the way I want to do it, I have to have a home. But that means that it doesn't necessarily mean that home is going to be the best financial investment. It's just my need to control whatever you're going to control more than if you were renting outweighs the alternative of another investment that may yield a higher return. But we don't really look at it like that.
I know.
It's more of a, we kind of want to buy. We're sick of paying rent, and we feel like we're at the age where we want to buy a home. We're going to be somewhere for a year, and we'd rather not pay rent. We could just be paying off a mortgage, and it just seems like it's time. And we want to be in this neighborhood. You can't rent in that neighborhood. Rentals aren't necessarily in a nicer part of town. We want to be in the suburbs. And so it's we're at the part of that life. We're at that stage. It's more cultural, rather than anything. And so, again, more just moving away from the fact that inherently a lower home ownership rate means to less wealth building opportunities. I think that's the mindset shift that we have to take on as a society and a culture, that we might want to dig into the details a little bit of, okay, I've got this theoretical nest egg of a down payment, $10, $20, $30, $40, $50, $60,000. How do I generate wealth to achieve prosperity for myself, my family, community, whatever, over time, while also being able to have some utility of a place to live and
whatever. Maybe there are ways to address those needs for control, privacy, for a way to kind of have your identity be associated with your home, which I think is really important for people.
I want to mow my own. I think a lot of times it's I want to be able to mow my own lawn. And if I want to paint the wall, I want to paint a wall.
I want to make my yard look great, and people think that I'm a cool person because I got a cool yard. You can't do that necessarily in an apartment. You don't have as much control in rental housing. Although if we could figure this out with single family rentals and and kind of give people a little more freedom.
And that's what I'm saying. I'm it's not like you can't do that. Now, there's the reason why landlords don't usually just leave the landscaping up to the tenant is because what if the tenant doesn't forgets to mow the lawn, and then you get a violation.
You mow the lawn a couple times, and then you realize maybe I don't want to.
But that, I guess that's where I'm getting at is how important is mowing the lawn and being able to paint the wall. Again, you could probably paint the wall, if you rented a house for a multi-year term or a year term. I don't think you have to pay to paint the wall. So what is the real need? Is it to? And I'm not asking.
No. I'm thinking about this.
I'm asking. It's rhetorical, but if you really get down to it, again, it really doesn't make sense. Other than it's we've been brainwashed by the banks to participate in buying these getting mortgages.
And you're talking about the same kind of similar things. I'm thinking that in the same way that people's expectations for home ownership and for their housing experience, in the same way that those can kind of change and may not be as fixed and universal as we thought. Maybe the relationship between renter and an apartment owner or single family home owner, maybe the landlord renter relationship could also kind of alter to accommodate this other shift on the other side.
And I think so. So there's going to be that demand, and we're talking, up next to the whole idea of build for rent.
Yeah.
Of why it's appealing to especially millennials and this demand for I want a house, but do I need to buy it or do I really need to own it? And then is it hey, we're gonna mow the grass, but
is a
garden in the backyard, go for it.
Is the
or HOA, you're gonna get fined. Okay, you can mow the lawn, but you're gonna get dinged, and we'll take care of it. We're gonna bill you.
Yeah. Is the build for rent neighborhood? Is it all cookie cutter houses? Do they all look a little different?
Mostly cookie cutter.
But I think that could be a big factor. You want something that replicates that feeling of buying and owning a home. Then maybe
like Village of West Clay.
Yeah, exactly. That's exactly what I'm thinking of.
Yeah.
Yeah.
But again, obviously, doing anything at any kind of scale, it's hard. It's hard.
Oh, that's more expensive
to do that. Yeah, let's do 50 one-offs versus let's design 2 or 3 different templates and.
Yeah. But I mean, I could see people.
No, but the appeal for sure is there. Well, Matt, you've given us a lot.
I know I could still talk for another hour.
I know, yeah, but people are gonna start turning off, Matt. We make these too long.
That's right.
So there's so I would homework. GrayCapitalLLC.com/newsletter. You're gonna sign up for the Gray Report newsletter. You're gonna get all these articles, videos, etc., emailed to you at least once a week, most likely twice.
Yeah.
And then, check us out, GrayCapitalLLC.com while you're there. Schedule a meeting to meet with our investment team. If you're a credit investor, you want to see what we do, what kind of deals. We like to crush it.
You could see us on Twitter. We're
on Twitter.
We joined it just the right time.
Exactly. So we're on Twitter, LinkedIn, Instagram, technically Facebook. What else are we on, Matt?
We're gonna get a TikTok. We're gonna get our TikTok on as well.
TikTok. We are on TikTok right now, but it's not if you go to our TikTok, it's like a picture of me and I think my 6-year-old.
We're gonna get it.
But it's Gray Capital LLC.
Yeah.
At Gray Capital LLC, and actually the first few videos. The first few videos. Have you seen them?
I glanced at the thumbnails. That's all.
They're a little bit. They're not from that long ago, but they're from long ago enough that. I don't know. They're not the most professional. So if you want me to see me just hey, I'm talking to the phone, without practicing telling you what a real estate syndication is, they're not bad. It's just that's one way to put it, Matt. They're not my best work, but they are work. So check it out. While those are still up, and there's a video of my dog, and then there's some random stuff. But there's gonna be a lot more focused. And we've got a whole new series of content that's going to be coming out very soon also. Blake Peroni and Griffin Haddad been putting some really cool stuff together. More bite-sized, more for the younger generation of accredited investors.
I'm going to get that on TikTok for first thing today, by the way.
Yeah. And you may ask, why? But the reality is, it's not just the kids. There's a lot of people everywhere. Yeah. It's how people are getting their information. And
they were onto something. I scrolled down even the YouTube shorts now. It's
very popular.
There's something primal and just not having to make a decision. You just click and it gives it to you, and then on to the next video. We want to be that next video.
We are the next video.
Yeah.
So Matt, this is a great episode. Just got to thank you. So for all of us here at Gray Capital, on the Gray Report, make sure you subscribe, leave a comment. We'll probably go to the comments next week.
Yeah.
We didn't have time this week, but we've been getting a lot of really good comments. We've got a lot of new people who have been subscribing. So if you're a new subscriber, we really appreciate it. That's why I'm sitting on the table, really out of appreciation. We'll catch you next time. Get in touch with us. I don't know. You can figure it out. All right. See you next week.